Now, contrast this with our friends at Wingify, right? I mean, everybody's known about Paras because he's been building bootstrapped for 17 years. Right? So it was not like a surprise that he was building something valuable and always profitably. He's never raised money. He owned 90% of the business, and his co-founder and team, team, owned 10% of the business. If you think about his journey, yes, it looks like, 200 million is not like a great number. It took 17 years. I think the way to think about it is, if he actually raised money, given his mindset, he might have, some founders do recognize that it might help them grow faster. So even if they're profitable, sometime in the third or fifth or fourth year, they would actually say, let me raise one round. So he might have raised, let's say back then, we're talking about early 2000s, the valuations would have been really rough. So there's a chance that, it's all hypothetical, but let's say somebody had actually played at a $10 million valuation on a company that was already doing $2 million of revenue back then. That's kind of, or maybe $1 million of revenue, and put in a couple of $1 million and picked up 20%. So today they might have grown faster, might have been a $400 million. And because of the way Paras is built, he might have still chosen to be profitable, kept the money in the bank, but probably got avenues to grow faster. And also might have had a greedy VC who wanted to optimize for the size of the outcome, and therefore sold this business for, let's say, 400 million. And that would have yielded, because there was no dilution, would have yielded 40x for the investor, because it was a 10 million post straight to a $400 million exit. But now all of this is me storytelling. None of this actually happened. But people, it's become fashionable in the Valley to say seed strapped. That's a new term, right? And somebody actually wanted to interview me on that and said, can somebody bootstrap at the seed round? There's another one which says one and done. We've been saying, we've had amazing examples in Fund 1, like in Exotel's case, they didn't raise for like 8 years after we funded them. So they were seed strapped in that traditional sense. And so this, at best, you can speculate and say, what if it was seed strapped? It would have yielded a 40x, 20% of 400 million, 80 million back. So it would have looked very close to Minimalist, actually. Though we are contrasting it, the story would have looked very close to Minimalist in terms of returns. Only difference, it would have taken, that entry would have happened, say, in the 5th year. This return would have happened over 12 years after that, because it's 17 years. But again, if you use the argument that it would have accelerated the progress, it might have happened in 8 or 10 years, right? The revenue would sort of 50 million, from what we hear is the business here, 50 million ARR, could have been 75 million ARR, which is what leads to the 400 valuation. And therefore, this could have actually happened in 7 to 8 years, which means when you look at the IRR on that, it wouldn't have been 70%, but it would have been 30-40%, right? Now, if you look at it simplistically from a 10x multiple perspective, let's say somebody had entered at 20 million. In the current world, if you have like a good seasoned founder and you're doing the deal at 20 million post, and you're only exiting at 200 million with no more dilution, but you hold for 17 years. A 10x over 17 years is only about, I did the math as we were starting to record, is only about a 17% IRR. Time basically punishes you for holding on for too long, right? And so basically you could have held for that long and you would have only made 17%, even though you made a 10 bagger. So I think it's all in hypotheticals, because no cash ever went in. It's like not infinite return. I'm sure when you actually do the math, all the cash flows that Paras was seeing in the early years, he would have reinvested into the business. And then when it didn't require that, he started dividending that out to himself and his team. So, he's been kind of semi-retired from Wingify for a while now. So look at him, like he's moved into the avatar of a promoter, non-operating promoter, or a financial investor, where the team was so well set and so was the product that it continued to compound and kept generating and throwing dividends. So it's a very unique business. Like it actually dividended out a lot of money for these folks. So that's why I think Paras wasn't holding on to like fighting for every last dollar, because he's seen dividends from the business, that's compounded. Now at 50 million, he has to leave headroom. So you'll ask, why didn't he optimize for the best possible price? Because Everstone, which bought the business, or 80% of it from what we hear, has done some things very similar to Minimalist. It's left Sparsh as the CEO, Paras moves on, but he's still holding some ownership from what the media reports, and both of them are playing for additional upside. So they have left, like in Minimalist, they've left some room for upside. And Everstone is playing for 25+% IRR. So if he doesn't see this grow to 500 to 600 million over the next 5 years, somebody at Everstone will ask the questions, why did you overpay? Right? And that could be either possibly to public, could be to another financial investor who thinks it can further grow 2.5, 3x, or it'll be to a strategic acquirer, part and parcel. You sell all 100%. And at that point, Paras and team, which own 20% today, can make it $20 million. So look at the upside that keeps multiplying. And everybody who buys with the intent of further compounding this value, either as a financial investor or a strategic investor. So it's not just about the transaction at that point in time. It's about how value is expected to continue to compound. And therefore, there's more upside for the buyer, and there's more upside for the team and the founders who still own a little bit of ownership. So these are the two big ones. If you see happenstance or fortitude that one got like 2 rounds of funding, one didn't, but they're very sort of similar journeys. One went very slow because it had no answerability to anyone, value was compounding, dividends were happening. The other one happened faster because I think there is pressure on everybody to, once a VC is there, to see the exit. And also significant capital. I mean, if you own 50% plus of a $350 million business, that's $175 million from the founders. It's not a bad chunk of change.